All right, welcome everyone. We are here with The Upside with Dylan Rieberer, portfolio manager and certified financial planning professional. Today we are talking about the news. We have tens of thousands of federal employees getting laid off, all of whom have defined benefit pensions. Dylan, you've worked with a lot of people with defined benefit, defined contribution pensions, people taking commuted values. Today we're talking about commuted values, what it means, should you take it, and all the different factors you should consider. So welcome.
Thanks for joining us. Yeah, it's good to be back. It's been a while.
Yeah, it has been a little while. What have you been up to lately?
Just managing people's pensions and stuff, and helping with that stuff, and a whole bunch of other things. Yeah.
You had a good holiday, a good Christmas.
Yeah, very good. I would love to say it was relaxing, but it was probably anything but.
Fair enough.
2 kids, and then end of year tax loss, like everything that happens at the end of the year and the start of the year for us. So, kept busy though in a good way, which is nice. Got a little bit of relaxation. How about you?
Good. It was good. 2 weeks of craziness. Definitely not a vacation with 3 kids under the age of 5 right now. Life's good. I can't complain.
Yeah, that's sweet.
Cool. So talking about defined benefit pensions. So a lot of people are going to be leaving employment. Anybody who's a federal employee has a defined benefit pension. What does that mean? What do people need to be aware of? Like, what is a commuted value effectively?
Yeah, well, and that's, for the most part, people don't even know that you have options for your pension plan, let alone this particular option, right? Most people just assume that their defined benefit pension plan, it's the type of pension where you just get the set monthly benefit. They just pay you and you don't worry about anything. You just get your money and don't think about anything and don't worry about it. And that's your retirement. But you have quite a few different options, quite a few different things to pick from, especially when it comes to kind of early retirement or, in the news right now, kind of a forced early retirement or forced kind of job transition to, the private sector or somewhere else.
Or maybe they'll get rehired back by the government. Who knows?
Yeah, who knows, right? So there's a lot of different options, and one big one that very few people know about because it's kind of in the pension's interest to keep as much money inside the fund as possible is you're allowed to take your money out effectively. Basically, instead of taking your pension as a periodic, monthly or annual payment, you can receive it as one big lump sum that you then invest yourself from there on, and that's what the commuted value is in essence, in very simple terms.
Yeah. And a lot of people will ask us, how do you calculate a commuted value? Or I'll get that question from people like, can you tell me what I'll receive? And the answer is generally no. I can't just look at the information of what your monthly amount is. There's obviously actuaries that have fairly robust programs that will be able to calculate out what that present value of those future payments would look like. So one of the things that we'll often encourage people to do is if you are getting let go or you're thinking of leaving an organization, obviously in this case you wouldn't be thinking about it ahead of time, but is you can actually request a computation of what that commuted value would potentially be. And so one of the key criteria that we ask people to look at is the first one is what is the size of a commuted value and based on kind of an interest factor. So when we look at interest rate timing, what does that mean to people who are looking at potentially taking a commuted value?
Yeah, so that's a big thing, and now we're getting into the idea of timing anything, which in finance is really hard to do, if not impossible, depending on who you talk to. But so without getting into the minutia of financial math and exactly how complicated it is and how it works, basically one of the biggest factors, and I say there's a lot, one of the biggest factors in calculating your commuted value, which like you said, for anyone listening who knows what the present value is, that's what you're calculating. Basically, you're calculating how much you would need to invest today at current interest rates and some other things in order to produce whatever the promised payments are through your pension. So basically you're finding the equivalent of $5,000 a month for the rest of your life. What is the equivalent of that in lump sum format received today? A big part of that is the interest rate that you would be able to invest that money at. And so basically the way it works is the higher the interest, all else equal, I should say that. Again, there's a lot of factors to this, but all else equal, the higher the interest rate is, in the going market rate today, or as of the day that you get your pension valued, right, the lower your commuted value will be, right? The idea, if you want to understand just a little bit of what's going on behind there, the lower the interest rates are, the more money you would need to invest up front in order to have the same future payments. And it works exactly opposite. If interest rates are higher, you would, in theory, need to invest less money up front to get the same promised payments. So if interest rates are higher, your present value, your commuted value, should all else equal, would be lower, and vice versa. So the idea with interest rate timing, and I'm of the mind that we're talking about a financial equivalency relationship. They're always equal, right? So the interest rates, what they are currently in the total value of your pension, is to a certain extent irrelevant, because you're still trying to figure out, you're still getting the amount that's equal to what you were promised in terms of payments. But the idea is to try to, wait till interest rates are a little bit lower so you get a higher lump sum. Now, there's some tax things with that, which I'm sure we're going to get to. But
that was literally my next point of that, which is, there's obviously only so much that can get tax sheltered. So, it's important to look at kind of interest rates. Unfortunately, most people don't get the option of when to time that. I remember kind of that 2015 to 2018 time period in Calgary. Lots of people in the energy industry getting laid off. Interest rates were super low. Fantastic time to take commuted values. It's not something you can control.
Yeah. Yeah, exactly. Right. Yeah. You're limited by a bunch of time things that we'll talk about. Right. But but in your experience, how you've managed that. But I know that my general kind of outlook on it is, like I said, don't worry so much about that because it's out of your control anyways.
Yeah.
How do you guys kind of handle that?
Yeah, exactly. Right. We're gonna make the best decision based on the circumstances of the situation we're dealing with right now, rather than hypothetically saying, "Oh darn, I wish this was the case." It's just not. So just deal with the information at hand.
Yeah.
Number one, interest rate timing. Number two, factor of how much can stay tax sheltered. So you kind of hit the nail on the head in terms of, obviously, if the amount is going to be a larger payout, only so much can be moved into a registered style of account. So walk us through, what does that actually look like when you get a commuted value? How does that work from a tax perspective?
Yeah, so for anyone who has or has heard of a LIRA account or LRSP or anything similar like that, that's what these come from, right? These are old pension monies that have been, if it's a DB plan, then they've been commuted, right? So you receive the lump sum, and that's what it goes to, right? So when you take the commuted value of your pension, it goes to some type of locked-in vehicle. For those who probably don't know, right, a locked-in vehicle like an LRSP, a LIRA, it's very similar to an RRSP account, except you can't contribute any money to it, right, after the fact, besides the commuted value, and it is locked in until a certain age. And then once you are able to start taking it out, then you're confined by maximum amounts that you can withdraw each year. There's lots of unlock. There's a whole bunch of stuff. We could have a whole podcast on just LIRAs alone, but basically that's what happens is it's a tax-deferred rollover, essentially, into one of those locked-in accounts. So your commuted value, most of it will go to one of those locked-in vehicles. Now, here's the big kicker is you have what's called the maximum transfer value, right, which is leading in directly to what we were talking about interest rates, right? If you have a really large pension plan or a really large commuted value, then what happens when the commuted value is too big and you've basically gone over the line of that maximum transfer value.
Yeah, so you're going to have a couple of different amounts, and some of it's going to depend on employment history, kind of pre-95 and 89 in terms of retirement allowances. But you're going to have a portion that you can roll over into an RSP, potentially if you have the room to tax shelter it, but you're going to have an excess portion, and that is going to be 100% taxable to you. So part of it is going to be based on the actual pension itself and kind of the underlying numbers. And what will happen is you'll get a breakdown from your pension partner that'll say how much of it can go into that locked-in account, how much of it can get rolled into an RSP, assuming you have the room, or it's going to be based on your room, and then how much of it is just 100% going to be added onto your taxable income for that year. And obviously that number is going to be affected by how much other money did you earn that year. So if you get laid off in January, great. You don't have any other income for the year. You get laid off in December and have to take that commuted value pension. Unfortunately, it's going to get added onto your entire taxable income from that year.
Which is, you touched on a great strategy, just kind of as an aside, if you are going to retire or if you are going to get laid off or whatever it is, try to do it in January, right? So that you can kind of more effectively plan these other large taxable events. But yeah, and then you also already kind of touched on it, right? But the maximum transfer value is how much you're allowed to roll over on a tax deferred basis, right? And then what happens to the excess is, if you have the room for an RSP contribution, right? If you have RSP contribution room left, you can make a contribution. But if you don't, then it all gets added. All the excess above that maximum transfer value gets added to your taxable income.
For sure. And there are those two different numbers. So there's the one that can get rolled into an RSP at source, so you don't have to pay the tax first and then make that contribution. And then you don't have the withholding, or you get paid it out, you have the withholding, and then you make that contribution to the RSP. So a lot of people get kind of switched up on those ones. So it's good to just get the information, review it with an advisor, and they can kind of usually break down kind of the most effective way to manage that.
Yeah, and that's the thing, right? We're giving kind of almost cliff notes at this point. There's so many different things that go on with it, right? But the bottom line is, a lot of people, going back to the very first question, a lot of people are concerned about getting the maximum lump sum possible. Keep in mind, it's an equivalency, right? You're only getting a bigger amount because it's harder to get good returns moving forward based on current interest rates. And if you get a big amount, you're much more likely to have to pay tax on a lot of it and lose it to tax than if you get a smaller amount and it can all be tax sheltered, or most of it.
Totally, and there's also the fact that most people who have defined benefit pensions, obviously that's a they have a pension adjustment every year, so they generally don't have a ton of RSP room. No, there's always unique circumstances, but that's generally the case. So, awesome. Number 3, longevity and health. So, if you're thinking of making a decision on whether to keep your money invested in the defined benefit plan or take a commuted value, how does longevity and health come into play?
Yep, there's a lot of factors that go into making this decision, and pros and cons. These are two of the biggest reasons to consider leaving your money in the pension. Is if you expect, which here's the kicker: how long are you going to live? If you tell me that, I can answer all your questions. But how long you're going to live. So your health, your longevity expectation, right? That is going to directly affect whether or not you're better off taking the pension or as a commuted value, or taking it as a regular pension. Basically, the longer you expect to live, right, you're probably better off taking that pension, because effectively what happens with pensions, and one of the big ways they're able to guarantee payments for life, is because people who die young, most of their money goes to the people who live to 95 and 100 and past that, right? So there is no longevity risk in a normal DB pension, right? They're just
assuming it's a well-funded pension.
That's always the caveat, isn't it?
I won't jump ahead too much. That's farther down our list.
Yeah, fair, right? So that's the big thing, right? And assuming you could reasonably forecast that, then it'll help make the analysis. But that's part of the problem, isn't it? Is we never know what's guaranteed tomorrow. Which I don't want to get ahead either, but that kind of feeds in one of the reasons I often do recommend pulling the commuted value for, again, not most people, but just situation dependent. It is a big pro. We'll get to that, but
totally. And the main takeaway from that is the fact that obviously you can have certain guarantee periods in terms of a DB plan. So you could have like a 5-year, 10-year, usually a 15-year guarantee. So that says like, if I pass away year 1, my beneficiary or pension partner is going to continue to receive, depending on the type of pension you set up. Usually it's the beneficiary could still receive payments for X period of time. But the whole concept is, if you leave it in that and you die, effectively that money is gone, right? So that's the whole idea of, okay, if you have a reduced, life expectancy, it might make more sense to take that commuted value. One, because maybe you want to spend more money in a shorter period of time, right? You might not want to have this guaranteed payment for the rest of your life. You might want to say, okay, I want to really front load that, or I'm going to spend way more money in retirement in my earlier years, so I'd rather have access to more of that early on. But we've had clients that, have had heart attacks, histories of cancer, histories of heart issues, and it just makes way more sense to have that money in hand rather than, hoping they're going to continue to live a really long time to kind of make that threshold.
And I mean, I'm a little biased because my profession and my expertise is investing for retirement, right? So for me, giving up that guarantee and managing the risk of investment risk with that money is not an issue, because I know I can manage it.
Yep.
But I would say, it goes beyond that, right? Like, I don't think pulling the commuted value is just for people who are, they expect to die young, right? Because I mean, the one thing,
it just kind of becomes more of a no-brainer is what I meant. But I agree with you.
And because that's the thing, right? Is like, for other people watching, right? All the really important things that Eli just talked about are, if you plan, or if you expect to maybe die young, or if you have, something happen, basically pulling the commuted value does 2 really important things. These are probably the 2 biggest reasons. And I think maybe we're getting ahead of the questions. This is probably a good way to just do it, is kind of talk about that as it goes. But the 2 biggest reasons, in my opinion, to pull the commuted value are more flexibility on your spending and more estate planning opportunities, right? Because yeah, it's true. You can pick guarantee periods and you can have survivor payments going to a spouse, right? But the problem with both of those is the more that you have going to your spouse when you pass away, the lower benefit you get to begin with. And same thing, the longer guarantee period you choose, and usually the most you can get is like 15 years anyways, which is usually, right, it usually means that people are going to die 5 years after that with no guarantee period, and they got a lower payment to begin with because they picked the guarantee period. At the end of the day, still, when you actually do the math, I shouldn't say that, but a lot of your money is ultimately going towards funding other people's pensions who live for a very long time. And for me, that's just a big reason. I mean, statistically speaking, you're not likely to live for longer than average. So just bringing it back to averages and statistics,
Sure.
it on average makes more sense
Yeah.
to be in favor of those other benefits.
Yeah, couldn't have said it better.
And obviously disclosure, while Eli pulls up the next question, this is a podcast, right? This is general information. Please do not just go and pull your committed value based off of this and then get mad at us when you do or if something goes wrong.
When you YOLO it into some crypto fund. Yeah.
Yeah.
Next one, next criteria, investment skill, discipline, and behavior. Obviously, we have no issue with this, but for certain people, if you are the type of person who, when you see money in your investment account, you just blow it, maybe taking a commuted value isn't the right move. Now, there are protections in place that say if you take a commuted value, it's going to go into that locked-in retirement account, and you can't access any of that money until you're like 50 or 55, and then there's maximums you can withdraw. There's certain protections in place there that you can't just do like they did back in the 80s where people just bought boats and houses and all this stuff when oil went sideways on Canadians. But there's still the fact of, are you a prudent investor or not?
Yeah. And, without getting too much into the investment side of things, right, investing for retirement is an entirely different thing. Now we're looking at, specifically, this is what all my research on is like sequence of returns risk, right, which is a very overlooked and misunderstood thing. But if you don't invest properly for retirement, right, it's catastrophic, right? We're not just talking about a lower rate of return than you otherwise would have gotten, right? We're talking about, running out of money too soon. And that is the biggest, in my opinion anyways, the biggest thing you give up when you take the commuted value, right, is if it's not being managed properly, you're giving up guaranteed income for life for, maybe running out of money in 5-10 years if you do things really poorly and get really unlucky. So making sure you manage it properly is, it's absolutely vital. It's critical. But, yeah.
And I like, the reason I don't love that one as much as a decision, because the same could be said about the pension manager, right? You could have very poorly managed pensions, and I would rather be in control of things and be able to, have more of an inside view into that, because we've all heard stories about pensions that, they aren't, kind of invested well. So, know yourself and know your behavior, but again, having that control, you can absolutely build a fantastic portfolio outside of it, a very pension style portfolio, and get better rates of return because now you can invest based on your own needs rather than the needs of tens of thousands of pension members.
Yeah, and that's a great point. I mean, like, what are you seeing from the pension side, right? Just in terms of current events, we've seen obviously some huge companies go to business, and then the pension obligations, are significantly reduced or eliminated. But I mean, how many pensions these days are underfunded, right? Like, people, it's not your money that you paid into the plan funding your benefits. It's people who are currently working, thinking they're paying into their own plan, and basically it's almost like a Ponzi scheme, right? It only works if people keep working for that company and paying into their pension plan.
For sure.
And why is that, right?
I think it was, I can't remember if it was Kentucky or what state it was, their teachers' pension fund, that when Russia, invaded, most of their money was invested in Russian banks. And one, why was that the investment of choice from a risk management standpoint? But then two, just in terms of like concentration risk and everything there, like it just made no sense. So that can still happen within a pension, right? It's not like this stuff is 100% guaranteed, even though that's kind of the idea behind the structure. So there's definitely still risk behind pension managers.
Is there any way for people to find out if their pension's in good shape or not?
Absolutely, they can they can call us. you can also get your annual report from your pension provider and get information. Whether or not you'll be able to fully understand and dissect that information is kind of another question. You can also hire an actuary to really break down the numbers in more detail. But yeah, funding percentages and that it's all readily available to pension plan members.
Yeah, that's great.
Cool.
What's next?
Inflation protection. Does your pension have full, partial, or no indexing? And commuted values are obviously not inflation protected unless you invest accordingly.
Yeah, and that's the one. I mean, a lot of the reasons for and against commuted values that you can get off of Google or whatever, or that you hear people talking about, most of them are valid both ways. But this one I find kind of ridiculous, right? Any financial planner worth their salt, when they're building your retirement plan and how they're investing in your money and everything, they're going to account for inflation. They're going to assume that you need your money to increase by a chosen percentage every year in line with inflation. So your commuted value, I mean, yeah, by default, I guess technically it's not indexed to inflation, but that's just a matter of planning and the way that you invest it.
Yeah.
So I don't really love that one as a reason not to pull your commuted value. That's
well,
just
it's also interesting that it says it's also a reason to pull it because your pension might not be indexed as well to inflation. So again, I don't love that one as much. I understand that people are going to bring that up, but yeah, you might have a pension and it is indexed to CPI but capped at a certain amount.
very common.
In which case, then all of a sudden, there's more value because during periods of inflation, typically, equity exposures would, grow faster, commodity exposures would grow faster, and so it's nice to have more control rather than, again, you're in a pension fund that it's limited by, the availability, I guess, of different investment options within having to manage money for tens of thousands of people.
Yeah, and that's such a huge thing too, right? You kind of touched on it already, but like the ability to invest according to your own, is that probably the next thing we're going to talk about?
No, but yeah, it's a good. You
Fair.
might as well talk on it now. Yeah.
Well, I mean, yeah, that's a big reason. It's a big reason against pulling the community value if you're not good at investing and if you invest poorly. But it's also a really good reason to pull it. Right? Is a lot of people think, if you invest in yourself, you're taking a lot more risk. You don't have to. You can invest just as conservatively as the pension would itself. You can also choose to invest a bit more aggressively, and you can invest along the full spectrum of risk and return profiles. Right? So. If you're more concerned with tax efficiency and keeping better pace with inflation and maybe getting higher returns so you can produce higher payments from your pension monies, then you can invest more aggressively. And if you're just really concerned about, I just want to make sure this my money is safe. I mean, one thing that a lot of people don't even think about because they're just not really used anymore because interest rates largely have been so low for so long that people have forgotten they exist. But annuities, you can effectively you can take the commuted value of your money and then use if you still want some guaranteed income. Unfortunately, there's no option to take half of your commuted value. You could take the full commuted value and then put half of it into an annuity. And now
Absolutely.
You have half of that producing an income for life guaranteed. And then you, depending on the annuity you choose, and then you can have the other amount invested, more aggressively to try to make, the opportunity to have higher payments, right? You can do anything under the sun.
Yep.
Right. So,
yeah, no, that's great. I mean, number 7, just jumping out, we'll jump 7 back to 6, but yeah, number 7, flexibility and control, right? Just that flexibility that's there is huge. And I think I touched on earlier in terms of, when you're retired, usually we talk about active versus passive retirement and the ability to be more flexible and draw down, more aggressively. One, you can invest the money the way you want to, but 2, you can also draw down and spend that more aggressively during the years where you actually have your health and can travel and do all that fun stuff rather than thinking I need the same amount indexed to inflation, whether I'm 85 years old or 65 years old.
Yeah.
Right? An 85-year-old just isn't going to need as much money as a 65-year-old who wants to travel and take their kids on vacation, and take grandkids and all those fun things that they get to do.
Right. Yeah. It's so rare to see that. I mean, the main exception is, if you have long-term care needs or health problems, but there's a lot of other ways of dealing with that too. And the other thing too is a little bit of tax management. All this money is getting ultimately rolled over unless you're over the maximum transfer value and you've got some portions that get taxed up front, and then maybe you put those in your TFSA moving forward. But a lot of this money is going into registered accounts that are just going to be taxable. But once you have your money in the LIRA and then you roll it to a LIF account, or an RLIF or some income variant of those locked-in accounts, you can usually, depending on the province or the jurisdiction that your pension was subject to, you have different options to unlock certain amounts of funds. And then from there, you can again, it's still taxable income to begin with, but now you have a little bit more opportunity to kind of manage tax, right? If you have a high tax year, if you sell a rental property one year and so you've got a big capital gain, you can choose to kind of temporarily lower your, RIF and LIF payments as opposed to just continuing to get the same pension, the same flat benefit every year, right?
Yep.
Or maybe you do what they call it, the TFSA or the RS RIF meltdown strategy, right? Where you take a little bit out of your RIF, if it makes sense from a tax perspective and roll it into your TFSA, right? It just gives you a bit more flexibility from a tax perspective to manage things long term. So flexibility with investments, flexibility with tax management, flexibility with spending and enjoying your money, which is a huge thing, right?
Totally.
Yeah.
Cool. Going back one, survivor and estate considerations. So we kind of touched on that a little bit in terms of you keep it in that DB plan, right? You past your, past your guarantee period. If you have one, that money's gone, right? So if leaving money behind you want to leave more money behind to your kids, grandkids, spouse, whoever, why would people want to take that commuted value?
It's probably it's probably the main reason in my experience that people take the commuted value, right? Is for estate, that and the flexibility part. But it's one of the main reasons for sure. So I'll start with this, right? The options available to pensioners, right? You got two main ones. There's your survivor benefit, which is how much is going to be paid to a spouse, right? So common law or married. And basically that one, it's usually, 65, 75, whatever percentage, right, of the former pension goes to the spouse. The higher the amount you choose to take or that you choose to go to your spouse, the lower the initial benefit. That's your spousal option or your pension partner option. Then you've got your, oh my goodness.
Beneficiary.
Right, the guarantee period.
Yeah.
Which is basically you'll pick a certain number of years where if you and, if applicable, your spouse both pass away before that timeline, then it's going to continue paying out for however many years are left, right? So if you pick a 10-year guarantee period and you and your spouse, heaven forbid, pass away in, year 5 and 6, then for years 7, 8, 9, 10, the pension will continue to get paid to a beneficiary of your choice, right? It could pretty much be anyone. After that point, there's nothing else really gets paid out. Depends on exactly when you die and how if you start your pension or not. But assuming you started your pension, you picked a regular kind of joint and survivor annuity style pension with a 10-year guarantee period, for example. You and your spouse pass away before 10 years. And when 10 years is up, you get nothing. And if you and your spouse pass away in year 11, the guarantee period's already over, so nothing else goes to anyone. And so that's when I say, when you actually run the math on this, usually you can leave a lot more to your spouse and to your kids or a charity of your choice or whoever you want by taking commuted value. Because basically 100% of what you don't spend when you die goes to your spouse, and then 100% of what's left once they're gone goes to whoever your beneficiaries are, right? So that's a huge thing for estate planning.
Yeah, absolutely. And you kind of mentioned something else, you were about to touch on it, but yeah, say if you pass away before you start making or receiving that contribution, how does that work? Walk us through that.
Oh, well, there's a lot of different ways that it can happen. Usually, it depends on how close you are to retirement, but usually you'll either get commuted value or you'll get something called the refund of contributions, which is not your employers, but just your contributions plus interest on those. Those get refunded to your beneficiaries, and then basically all your employers' contributions and everything else kind of goes to the rest of the pension fund.
Yeah, and that's usually based on people who didn't have they didn't reach that vesting point. Generally speaking, you're going to get that commuted value, kind of transfer. But certainly, there's lots of pensions that don't vest. Some of them have 2 years, some of them have 5 year, and it's just basically you're just getting your contributions back plus an interest factor. Yeah, right. And
so it comes to the it's actually something I don't know if we touched on, but the when you can take your commuted value and when you can't, which is early retirement. The early retirement age is a lot of stuff happens before and then after that age. So you can't take your committed value until any time after that early retirement age, which is usually age 55. It depends on the province and the pension, but for the most part, it's 55.
And we're talking government pensions here. Obviously, with private pensions, there's lots of different variations in it, but for sure,
because you have pension factors. Anyways, so yeah, that's the thing is if you committed value largely applies to people. We probably should have said this at the outset. It mostly applies to people who are retiring a little earlier than normal retirement age. So like I said, usually 55, but it can vary a lot. Once you're after that age, you don't have that. They take that option away from you for the most part, which is unfortunate. But that also kind of feeds into exactly what gets paid out if you pass away before or after early retirement age, and then before or after taking your pension, because that'll determine whether you get refund of contributions, commuted value, or if you get the survivor pension or guarantee period paid out.
And there are extenuating circumstances that I think probably the most common one we see is divorce. Even if you started taking your pension, or if you've decided to take the DB and you're over, 55 and you haven't started drawing it, doesn't matter. In the event of breakdown of relationship, breakdown of marriage, you do have the option for commuted values. I wouldn't get divorced just so you can get your commuted value, because I've gotten that question before, and there's some other factors at play there that you should consider first, whether ending your marriage is worth it just for the commuted value. But yeah, I mean, there's options, I guess, right?
Yeah, I guess, yeah, whatever tickles your fancy. I've never heard of that, but that's hilarious. Does that really happen?
Yeah. Oh, yeah. They're like, so we just need to get divorced and then we can get our commuted value out of this thing. I was like, technically, yes. But I wouldn't do it just for those reasons. There's other consequences involved in this decision that you probably don't want to go down that rabbit hole.
No kidding. Oh.
Cool. Employer plan, sponsor risk. We actually already talked about this one, right? In terms of how well is it actually managed? How well is it funded? Integration with the rest of your wealth. So the whole concept of there's other factors at play here, right? You don't have a pension in a silo that's different from everything else, right? You're going to have other RSP accounts. You're going to have potentially other pensions. You're going to have OAS. You're going to have CPP. You're going to have inheritances. You're going to have potentially rental properties or other real estate, or kids to look at. Like, there's all these different factors, right? That whether your decision is going to be based on your individual needs and the integration with the rest of your life.
Yeah, and there's not really much I can add besides just it depends on all those things, right? Whether it makes sense or not for you. Because if we haven't made it clear enough yet, and again, we're kind of just scratching the surface of this stuff, like there's a lot that goes on in this one decision. Pensions are extremely complicated, managing them, whether it's community value, like when to take it or not, all that stuff. There's so many factors in it. I don't know. Can you think of any particular situations where it tends to make sense and tends not to? Or
I have dealt with this quite a bit. I remember the Dirty 30. There was CPS, Calgary Police Services, when they're making changes to their community value, and a whole bunch of people, what they did is they took their community value and then basically went back to work the next month. I had one just this month. She technically quit or retired on the 20th, went back to work on the 21st. Took her community value because that was her 55th birthday, right? So there's these circumstances where people want to get that community value, but they're going to hit that age threshold, so they quit and then they go back to work, and you're contributing to a new pension plan because they want kind of that flexibility there. So there's some neat extenuating circumstances that we'll run into. That one we just come across quite a bit because a lot of people actually just find that out when they're about to turn 55, and all their colleagues go, "Are you going to take your community value?" And a lot of people do.
Yeah, I mean that's probably the one where you see it the most. People are like retiring early, or I don't know. There's no real one way, and it's probably not even worth it to try to give a generalized piece of advice of if you are X, Y, and Z, then maybe you're more likely or more it'd be better for you to take community value, because it just really depends on so many things. And we haven't talked about it yet, but risk tolerance, right? We've kind of hinted at it through talking about other things, but I mean, never make financial decisions according to your emotions, but it's always gonna be a factor.
Sure.
Right? And if it's gonna stress you out to know that your money is not quote unquote guaranteed anymore, right, for life, then maybe having a bit more flexibility, having more estate planning opportunities, a bit more money maybe because you get better returns. Maybe none of that's quite worth the stress, not being able to sleep at night. And at the same time, maybe you lose sleep, knowing that you have no control over your investments, and you feel limited in how much you can spend and how much you can be able to leave to your spouse and kids, so that's always going to play a factor too. Is considering, at least now that everyone who's watching this knows it's an option. If they didn't before, at least now they know. Now they can make that decision, right, and think about what it would look like and feel like.
Totally.
If they did or didn't.
I did think of one. I ran into a pension program where they got a supplemental pension if they kept it in, but there was no commuted value of the supplemental pension that they got from, I think it was either age 55 to 65 or 60 to 65. They got a supplemental pension, and that had a payment value of, it was a small one. It was like $35,000 in total payments. But if they took their community value, they'd walk away entirely from the supplemental pension. So we decided to just keep it in that pension. It made more sense. They took a community value of a different one. That one we just left it in. But again, those are kind of like niche, little nuanced things, which again, to your point, it's why you should sit down with a professional. Yeah,
right. Because I mean, if I saw something like that, the first thing that comes to mind would be, trying to run a calculation, based on a conservative rate of return. It's like, can we make you $35,000 in 10 years on however much the community value is? I mean, depending on how much it is, who knows, probably. But I mean, even in that one, I can think of a bunch of reasons why possibly you might actually still want to. But I mean, case in point, way too many things to look at on your own.
Absolutely. Well, thank you very much, Dylan. That was a lot of information to throw at people all at once. If you're interested in booking a meeting with either Dylan or myself, feel free to reach out. If you have additional questions around pension programs, commuted values, locked-in retirement accounts, lift accounts, whatever, feel free to leave in the comments, and we will absolutely answer them for you. So thank you very much, Dylan.
My pleasure. Good to
Take
see you
care.
again. Bye.